So having established our understanding in the theory of IAS 37, that is contingent liabilities and contingent assets, you want to take some few practical questions and see how you will solve them in case we meet them in the exam situation. So in the first scenario, the first question you're going to look at is that it said a number of products are sold with a warranty. So a number of products, as the question projected on the screen, a number of products are sold with what? Warranty. So warranty is another form of provisions that entities will give, or it's just like after sales services. Is that okay? So a number of products are sold with what? With a warranty. So we are told that at the beginning of the year, the provisions stood at $750. $750. So we have $750. And then during the period, the provisions that was incurred, or the number of claims that have been settled from the provisions were $400. And then we were told that as at the year end, there were unsettled claims from 150 customers. So we are having 150 customers. And then also we were told that experience is that 40% of the claims submitted do not fulfill warranty conditions and can be defended at no cost. So the average cost of settling the other claims would be $7,000. That means if you want to settle your claims, we are going to have an average price of $7. So the average, price of settling a claim is what? $7. This is the question we have. We were told that the opening provisions is $750. During the year, we were able to settle $400, and then it hasn't. We are still having claims unsettled with 150 customers. But we were told that experience shows that 40% of the claims submitted do not fulfill warranty. So the condition in the question is telling us that 40% does not have anything to do with warranty. That means 60% of the customers are having issues with what? With warranty. But 40%, the condition is saying that experience is that 40% of the claims submitted do not fulfill warranty conditions and can be defended at no cost. That means we cannot provide for 40% of the of the 50, but we can make provision for 60% of the customers. One thing you are supposed to note is that anytime you want to undertake the double entry, entries for provisions, we are saying that you first have to debit your P&L account, because it's going to be as an expense, and then you will credit provisions account, because provisions are always expenses. But in the case there is a recovery or there is a reimbursement of a provision, then we are going to debit our provisions, and then we are going to credit the reimbursement account, because it's an asset to us as well. So if there is any decrease in the provisions, probably we are going to debit it, and increase in provisions will probably be debited. Another thing you are supposed to note is that at the end of every accounting period, you are supposed to check whether there is an increase or decrease in provisions. Since provisions is a liability, an increase in provisions will become an expense to the entity, and a decrease in the provisions will become a gain to the entity. We are also supposed to remember that under the IAS 37, compare, or you are supposed to analyze or review provisions at the end of every period. An increase in the provisions will lead to an expense in that increased value, and a decrease in that provisions will lead to an income with that decreased value in the books of the entity. So this question basically presents that particular scenario. What amount of provisions are we supposed to enter in the books of the entity at the end period? So this is how we are going to go about it. First of all, we are going to have our balance brought down. So remember that all figures are in dollar currency. So the balance brought down is $750. And then we were told that claims during the year, so claims during the year was $400. So we have, out of this opening, we have made claims of $400. So we are going to less this from the 750 opening balance, and this is going to give us 350 dollars. But how much are we supposed to account for as a result of the warranty that we have provided from the 60 for the 150 customer, that we were told that 40% of the claims submitted do not fulfill, but 60% do fulfill the warranty conditions. What it means is that the 60% of the 150 customers meet the warranty conditions. If that's the case, then what value are we going to present to add it to the adjusted value here to get our total, provisions figure for the period? So in this case, we know that we were told in the question that the average cost, if you want to settle a customer, it is what? $7. So in this case, it's going to be the 150 customers multiplied by the $7 multiplied by the 60% of what? Customers that meet the, the warranty conditions. So in this case, if that's the case, then we are going to get 630. So we go and add 630 to the value we already have here, and then you have our provisions for the period. So provisions for the period, which is going to be the addition of this. So we have 089, which is going to be 980 as our provisions for the period. So that is it when it comes to this particular type of question. Right, so let's look at the second scenario presented on the screen. So we were told that on 1st July, so here the date should be taken into consideration. So we place much importance to the date. So we were told that on 1st of July 2018, an entity, RONAS, entered into a 2-year fixed contract. You see, this is a fixed price contract that we cannot terminate because it's placing an present obligation on us. So we are saying that fixed price contract to supply customer 100 units per month. So we are going to present 100 units of products per month. Now let's look at the other information. They said the forecast profits per unit was 1,600 bahts. So the forecast profit, the profit that we forecasted was $1,600. But due to unforeseen cost increases and production problems, each unit is anticipated to make a loss of what? 800. So out of this 1,600, because of the unforeseen event, they are assuming that each unit is supposed to make a loss of what? $800. That means we are going to be left with only $800 as what? The selling price. Out of the 1,600, we are only going to make a profit of what? 800. There is a loss. Now, they are asking us that at the end of the period, what will be the provision? They said we should prepare the provisions and contingencies note for the financial statement for the year ended. So the year period is the year ended 31st of December 2018. So 31st of December 2018. By year, remember that the contract was for what? 2 years. The contract was for 2 years. Over here, the 2 years period. And we're told that there is a decrease in the profit as a result of all unforeseen event. Remember, there is always unforeseen event and happen. That's why you make provisions for those expenses. All right, if that's the case, then we were told that we are supposed to provide 100 units under a fixed price contract. This is giving us what we call an onerous contract, because look, the expenses will be high, but we are going to lose a profit of 800. So at the end, the unavoidable cost, because it's a fixed price, it's a fixed contract, so the unavoidable cost is going to be greater than what the benefit we are going to realize at the end of the period. So in this case, what value of provisions are we going to present in the books of the entity? This is how it goes. Remember that we are having 100 units to produce, it's a fixed contract. So whether we are making a loss or not, it's a fixed contract. Then 800 of them is supposed to be what? It's supposed to be a loss. 800 of them is supposed to be a loss. And then also, how many months is left? So we have here to do what? Because this unit is provided per month. per month. So in other words, this will rather be times the number of months, which is what? 18 months. It's 2 years. Now we started on 1st, July. So it's 6 years in the first year, and then 6 months in the first year, and then 1 year or 12 months in the next year. So it's going to be 18 months multiplied by the number of loss we are going to incur. And this is going to give us the value. All right, so the value of our provisions that we are going to present or recognize in the books of the entity is going to be $1,440,000. $1,440,000 is going to be what we will present in the books of the entity. So that is basically about how to go about such questions. Thank you. Remember, if you have any questions, you can leave it at the comment section, and you will rightly be attended to. Thank you.